All right, we'll go ahead and get started. So first, I like to start with what is a credit union? If you're not familiar with what a credit union is, we provide not-for-profit banking products, loans, and services to our members. Credit unions are member-owned, so you have a say in how the credit union is led and operated. Every member is an owner, so it's a democratic financial institution where members vote for the board of directors, those making a lot of those high-level decisions for the credit union, to have a say in how the credit union is run. The overall difference is credit unions are for people, not profit. A little bit about Zing and who we are. If you knew us previously as Denver Community Credit Union, we are still the same organization as Zing. We did transition to that new name in April of this year. Our mission is to educate, deliver, and achieve. We want to have a financially educated community so everyone can be reaching their financial goals. As I mentioned, we are a not-for-profit financial institution, and we have been serving the Metro Denver community since 1934, so we have been around for quite some time. This class is a part of our free financial education program that includes live classes like we have today. If you work at a company or an organization that wants a financial education class, please reach out to me. We do them with our partners and other organizations as well. We have recorded classes like this class at myzing.com/recordings, free one-on-one private financial coaching via phone or Zoom, and then lastly, e-learning courses. And one cool thing about the e-learning courses is they are available in both English and Spanish there. Now, diving into today's Create Great Credit content. So to familiarize everyone with some different terminology and vocabulary we're going to use throughout the class, we're going to talk about 4 people's credit situations. So first, you can see here we have Brad. Brad has 0 trade lines or lines of trade. Trade line or lines of trade, it's kind of an interchangeable term, so you can use either one there. A trade line or line of trade is any open and active loan, credit account, or line of credit that is actively being reported to the credit bureaus. So this could be your credit card, auto loan, mortgage, anything like that. We'll also talk about 2 different loan types today. The first one is revolving loans. These are loans, like it says, that are constantly revolving. So like credit cards and overdraft lines of credit are a good example of these, where you can use up to a certain dollar amount and then you pay it off when you get your statement. So the line is constantly revolving. We also have installment loans. This is any loan paid in installments over a specified term. These are going to be things like a personal loan, a mortgage, an auto loan where you borrow a set dollar amount and then pay back a monthly payment over X amount of years or months. Brad has had 2 inquiries in the last months. We will discuss 2 different kinds of inquiries during this class. First one is soft inquiries. These do not impact your credit score. So these are oftentimes for background purposes. Maybe it's for employment or for a utility company or for getting a new phone. So it will not impact your score. Basically, they're just checking to see your repayment history. And then hard inquiries, these do impact your credit score. So they are different. You will see a drop in your credit score of about 3 to 10 points anytime that you open or close a trade line or line of trade. So that's why it's important to only open credit when you really need it. You don't want to apply for a lot of credit at one time because you'll see a pretty big drop in your credit score there. So hard inquiries really only happen when you're applying for a new loan or line of trade. Soft inquiries are kind of for background purposes, if you're pulling your own credit information and so on. If you're ever curious if a company says, hey, we're going to pull your credit, you can always ask them if it will be a hard or a soft inquiry. So now we have Greg. Greg has some unpaid collection accounts. And when we talk about a collection and what that is, that oftentimes is a debt owed to a lender or company that's then sold to a collection agency after 180 days of non-payment. So for example, if I have my Xfinity bill for Wi-Fi and I don't pay that bill for 180 days, oftentimes Xfinity is going to sell that debt to a new collection agency. And when that happens, it will display as a new additional negative account on your credit report. So you will still have that original account with Xfinity that shows the late payments, and then it will also add the collection on top of that. So now you have two negatively reporting lines on your credit report. So it is always better to try and get that debt paid with the original company it's with before it's sold to a collection agency. One thing to note, any collection account is damaging regardless of the balance owed. It could be $25 or $2,500. Both are going to be equally damaging. And then another thing, paying off a collection account will significantly improve your credit score. So if you have a collection, it's okay, things happen. Work on getting that collection account paid off, whether it's in monthly payments or in full, whatever works with your income and your means. And you should see your credit score go up as a reflection of paying off that collection. And then Greg's length of credit history is about 72 months. So the longer you have a positive credit history, like making on-time payments, the better your credit score will be. We have Helen. Helen has 39 trade lines and 24 paid accounts. I would assume Helen is some sort of business owner. I would say the average American has about, 3 to 6 different trade lines. She is current on all accounts, including her mortgage. So that just means she's paid everything on time. It's good to go. She has about $10,500 in credit card balances, but her total available credit is around $70,000. So if we divide that 10,500 by 70,000, she's using about 15% of her credit limit, which is okay. She has no delinquent accounts, so no collections and no late payments. One thing to note about late payments, if you do have a late payment reported to the credit bureau, it can stay on your credit report for up to 7 years, a long time. Don't let that freak you out by any means. I know when I heard that, I was very scared at first. Sorry. Basically, if you continue to make on-time payments on your other lines of trade, you don't open up a bunch of credit at one time, your score should bounce back. You will see a drop because of the late payment, but your score will bounce back as long as your other credit usage stays the same. And typically late payments are reported after being 30 or more days late, but not always. It really depends on the lender or the company. I know for myself, I had a late credit card payment once. I think I was 15 or 16 days late. My auto pay just stopped going through for some reason. Luckily, that was not reported to the credit bureaus as a late payment, so I was lucky there. Lastly, we have Sarah. Sarah filed for bankruptcy in 2019. Most bankruptcy filers will repay their debt after filing a Chapter 13 bankruptcy, which stays on your credit report for 7 years. But there is also Chapter 7 bankruptcy, which is less common, but that will stay on the credit report for 10 years. Bankruptcy is a true last resort legal process, and in the United States, medical debt is the top reason for bankruptcy filings. Sarah has had 9 inquiries in the last 6 months, so she's been applying for a lot of credits, way more than I would recommend. I recommend maybe 1, possibly 2 inquiries every 6 months. I normally say 1 to 2 for the whole year, but it really just depends on what you need for credit or what lines of trade need to be accessible to you. Sarah is maxed out on all credit cards. When I say maxed out, that means at or above the limit of a credit card or a line of credit. So basically, if Sarah had a $1,000 credit card, that means she has $1,000 or more put on that card there. If we're going to use the term credit utilization when it comes to revolving lines of trade, and what that means is the percentage of the limit used on a revolving loan. So if you think back to the last slide, we talked about Helen. She had about $10,500 on her cards, but $70,000 available to her. Her credit utilization was that 15%, or how much of her limit is she using currently? Sarah does have one really good thing going for her though, and that is that she hasn't missed a payment since bankruptcy. So she's been making on-time payments, staying on top of all that stuff since she filed, which is good. Keep these 4 individuals in mind as we go through this class, and we'll discuss who has the best credit score later. All right, a quick poll question for everybody here. You can just respond in the chat box, A or B. What is the best definition of credit? Letter A, credit is a number lenders use to determine whether to give you a loan or not. Or B, credit is confidence in a borrower's ability and intention to repay. What do you think? I got a B. Anyone else? B, absolutely. Thank you to those who participated. B is correct. Letter A is actually the definition of a credit score. So credit score is that physical number that lenders are going to look at, but the overall definition of credit is just knowing, is someone going to be able to pay me back or not? So now we're going to dive into credit reports. So first, what is a credit report? In your credit report, you're going to see a lot of personal information here, like your name, social security number, birth date, addresses, and phone numbers. These may include previous addresses that you may not live at anymore. That's totally normal. It will include your loan account information, so accounts that have been opened or closed in the last 7 to 10 years, dates that these accounts were opened or closed, your payment history, credit utilization, your account balances, and loan payment statuses, like are they current, are you 30, 60, 90 days late? Public records. You may not have anything in this category. These are going to include things like bankruptcies, foreclosures, tax liens, and civil judgments. Your credit report will not include your income or any bank account information, so none of that is included there. And one thing to note, that businesses, including lenders like credit card companies and auto loan companies, do not have to report to credit bureaus. So that's why it's always important to ask a company, hey, do you report to the credit bureaus? And if they don't, I would not pursue getting a loan or a credit card with them, because if you do and they're not reporting to the credit bureaus, it's not helping to build your credit score. So as you can see as that last bullet point there, credit scores are based only on the information and your credit reports. So that's why it's so important to ensure credit bureaus are involved. There are 3 separate credit bureaus, and they are for-profit companies. So that is one thing to note. If you try and go directly to these companies' websites, they may try and charge you to access your credit report. So there's Experian, TransUnion, and Equifax. Experian is my personal favorite because if you make an account with Experian, basically sign up with your email, create a password, they will provide you with a free copy of your Experian credit report once a month, and a free copy of your Experian FICO score. So Experian does have some really good resources. I'm not aware of any free resources that TransUnion or Equifax provides at this time. Now, looking at a sample credit report, your credit report will realistically be multiple pages long, even if you haven't used a lot of credit in your lifetime. But you will want to look for these 5 information zones, regardless of how long your credit report is. So first one, personal information. You'll see your name, social security number, addresses, phone numbers, and it is worth it to remove or dispute any addresses or phone numbers on there that you don't recognize. You want all that information to be completely 100% true to you. Section 2, public records or legal items. As I mentioned, you may not have anything in this category. Section 3, collection items. You can see that we have one collection here from July of 2018 for about $500. If this was your credit report that you were pulling, it would provide you with contact information like a phone number to contact that collection agency to resolve that, whether it's making a payment plan or paying it off in full. Section 4, trade line. This is that really meaty part of your credit report. So any open or closed trade line in the last 7 to 10 years. So if it's been closed, it will stay on there for another 7 years afterwards. If it's open, that will also be on there as well. So you can see we have 3 trade lines, a bank card, I'm going to guess a credit card, an auto loan, and a retail card, it looks like. So you can see the date reported, the date that it was opened, the highest credit limit, the balance, and then the status. And when you see current, that just means everything's on time. Lastly, section 5, inquiries. You will see both hard and soft inquiries on your credit report. So here we have one for a cell phone issuer provider. I'm going to guess that was a soft inquiry for a background purpose. And then we have another one for a card issuer. I'm guessing for a credit card. That would be a hard inquiry where this person probably saw a 3 to 10 point drop in their score when they opened that new card. Mistakes are common on credit reports. I think the stat is about 20% of Americans have some sort of error on their credit report. It could be something small, like maybe there's an address on there that's not yours or you don't recognize, or it could be more serious things like accounts or collections on there that aren't yours. I recommend going to annualcreditreport.com for free credit reports once every 12 months. So if you pulled all 3 of your credit reports today on October 12th, you wouldn't have access to your credit reports again until October 12th of next year. So that is one thing to note. I personally kind of like to space out how often I pull these credit reports because you don't have to pull them all at once. You can just pull TransUnion now, then you could pull Equifax in like 3 or 4 months, and then you can pull Experian later. Experian is nice. Like I said, they offer you that free credit report and FICO score once a month if you have an account with them. One benefit of annualcreditreport.com is you can dispute any errors and inaccurate information and have it removed completely for free. So that doesn't cost you anything. It's a pretty simple and easy process to start that dispute. So now we're going to look at a series of different accounts or things that we'll probably open or access within our lifetime and see if credit is important for them. So number 1, a checking account. This one goes down the middle. Unfortunately, I couldn't put this on one side or the other because it really depends on the financial institution you choose to go to. At Zing Credit Union, we do not do a credit check for checking accounts. We check something called check systems. And what that is just to see if you have a negative outstanding balance at another financial institution. But I have been to other credit unions before where my credit was checked to open a checking account. Number 2, getting employment. This one also goes down the middle. It really depends on what industry and even what career you're going into to know if your credit score would be checked as a soft inquiry for background purposes or not. I know when I got my job at the credit union, they did do a soft pull to see where my score was at. Rent-to-own store. This one is in the middle as well. We used to have it on the credit score is not important side. But we did have some members say that their credit was checked at a rent-to-own store. I personally don't recommend these stores. Oftentimes they attach pretty high interest rates to the monthly payments while you're, quote, renting the item until you own it. So just keep an eye out for that. Renting a place, absolutely, credit will be important. Most landlords or leasing agencies will do a soft check on your credit to see your repayment history. I know for me, I was actually able to save a lot of money on my security deposit by having a good credit score. They said either $500 or a full month's rent, depending on where your credit score fell. Luckily, I fell on that $500 side. So saving some money in my pocket, not having to put as much down for a security deposit when it comes to renting a place. Auto loan, absolutely. It's going to be credit will be very important for auto loans, saving money by getting a lower interest rate. And we'll actually look at the dollar impact of a credit score for an auto loan later on in this class. Absolutely. A mortgage or home loan, credit is going to be important. For most of us, this is one of the largest purchases we'll make in our lifetime. So having a good, strong credit score can save you thousands and thousands over the lifetime of a 15 or 30-year mortgage. And this was something I did not know before taking this class, is that having a good credit score can actually save you money on auto insurance premiums. I guess that's something that goes into their system as they're calculating how much you're going to pay for your premium every month or every 6 months. So good for auto insurance as well. A couple things on the credit score is not important side. First one is payday loan. Although it has the name loan in there, payday loans are oftentimes bad news bears, as I say it. They oftentimes have very, very high interest rates. I believe Colorado actually just passed a law 2 to 3 years ago limiting how high these interest rates could be, because oftentimes someone will get a payday loan and they'll get a payday loan to pay off that payday loan. And then it ends up just being a vicious cycle of someone trapped in this payday loan with this really high interest rate that it's really, really hard to get out of. And then lastly, a pawn shop. As long as the pawn shop has your item of collateral to sell, if you don't pay up, they do not care about your credit score. Now, diving into FICO credit scores. FICO credit scores are the most commonly used credit scoring model in the United States. It's used by about 90% of lenders. So when you see a FICO score, there's a good chance that's what your lender or company is going to be using when they check. These scores will range from 300 to 850. 300 is the lowest score you can have. 850 is the highest. And it, like I said earlier, it's based only on information in your credit report. So that's why it's so important to ensure your lines of trade, like credit cards, overdraft lines of credit, auto loans, mortgages, are being reported to the credit bureaus. You will have 3 FICO scores, one for each credit bureau. So that is one thing to keep in mind. And please note that they are probably all a little bit different. They're normally not all the same across the board. I would expect maybe like a 1 to 10 point difference between your scores. Nothing too crazy, but oftentimes they're all just a little bit different. And your FICO score is based off of 5 different categories. The importance of these categories really, really varies by person depending on their credit profile. A lot of times people ask me, well, if I miss a payment, what's going to happen to my score? And that's a really, really hard question for me to answer, just because everyone's credit makeup is so different. We'll look at an example in a few slides here. So I think that this is probably the meatiest, best slide we have in here, because this is the breakdown of what your FICO score makeup is. So this really helps you, and when it comes to building your credit score, hitting all of these items to ensure you're growing your score as much as possible. So number 1, payment history is 35%. That means that the largest portion of your FICO credit score here is just paying things on time. This is going to look at things like how recent was your most recent delinquency, collection, or public record item. How severe was your last late payment if you've had any? Was it 30 days, 60 days, 90 days? How many of your lines of trade have been paid late? Is it just one or is it several of them? And on-time payments to installment loans like personal loans, credit builder loans, auto loans, mortgages will help your score more than on-time payments to revolving loans. I only say that just so you have that piece of information. I personally started with just one credit card, got another credit card, and then just got my auto loan when I needed it. So I never recommend going into unnecessary debt just to build your credit score. There's a lot of financially stable ways to do so that we'll discuss later. Now, credit utilization, you've all heard that term before. 30% of your FICO score there. So that is sometimes also called your quote, outstanding debt. So collections are taken into consideration here. And then also, how much are you putting on those credit cards every month? Are you maxing them out, or are you keeping those balances low? Length of credit history is 15%. So this is looking at how long have your accounts been established, the average number of months accounts have been open, new accounts, the number of months since your most recent account opening. So another reason you don't want to open up a lot of credit at one time, not only would you see a significant drop in your score, but that's really going to shorten up the average length of your credit history. If you only have 2 lines of trade and then you open 2 new lines this month, that just shrunk your credit history basically in half. So that's why I say only apply for credit when you need it. That's the best way to do it. Amounts of new credit, 10%. This is going to take into consideration those inquiries. So the number of credit inquiries you've had in the last 12 months, number of trade lines you've opened in the last year. And then one thing to note, FICO scores only consider consumer initiated inquiries for the credit posted in the last 12 months. And what that means is sometimes we'll get these letters in the mail from credit card companies that say, hey, you've been pre-approved for this credit card. That does not hurt or impact your credit score in any way. If you were to fill out that credit card application and send it back in and apply for the credit card, that's when you would see the credit pull. But those like pre-promotional offers, those do not impact your score. And then lastly, types of credit in use. We like to see a mix of credit, so both revolving and installment loans. But I always tell members, really focus on those first 3, your payment history, credit utilization, and length of credit history. These are the most important. The last 2, they matter, but they also kind of just come with time. Now, thinking back to those 4 individuals at the beginning, we had Brad, Greg, Helen, and Sarah. Who would have had the highest score? The answer, kind of obvious, Helen. Helen had the best credit score. She was on time on everything. She had no late payments, no delinquencies, not too many inquiries. Her credit utilization was at a good spot. So overall, Helen had the best credit score. And I get this question a lot. Is having a good credit score, the best, most important skill or the only thing I should work on? And credit is a very important tool when it comes to money management, but it's not your only tool available to you. It's a really good resource to help you save money when it comes to loans, but you want to manage your money in a way that helps you reach your financial goals and it aligns with your values and priorities. So this is that dollar impact of a credit score when it comes to auto loans. This is just an example. So these are not our current auto loan rates, just put here for the purpose of this class. But when it does come to applying for loans, we do have credit scores kind of tiered like this. So basically wherever your credit score falls, maybe it's a 705 in that B plus range, that would align with the 6.99% APR or interest rate for your loan. So they are oftentimes kind of set up where if your score falls in a certain range, it will align with a certain interest rate. These are just not our current rates. So looking at the cost difference between someone with a 4% APR in that A plus category versus someone in that lower category, 17.25%, very, very high interest rate for an auto loan. The loan amount and length is the same, $10,000 over the course of 5 years, pretty reasonable used auto loan right there. Their monthly payment differs by about $65. So when I first saw that, I was like, okay, $65, that wouldn't make or break my budget. But when I look at the total interest paid over the life of the loan, that's when we're talking about a chunk of change there, almost $4,000. I'm sure everyone in this class can think of $4,000 worth of things or places they'd rather go than just putting it towards money on their auto loan. So this is a little bit of a dramatic example between these two interest rates, but it does just go to show how much money you can save in the long run by having a good, strong credit score. Now, can you have a credit score without using credits? The answer here is no. Unfortunately, someone who does not use credit would just have no credit score. The reason is you need regularly reported on-time payments to build your credit. Normally, we say it takes about 6 months to build a strong FICO score. So that's what we normally recommend. If you open a line of trade, at least wait around 6 months or so before opening something else, just so your FICO score has had a chance to build up. And the one thing is you can be considered a risky borrower if there's no history or data of repayment behavior. So I always use the example, if I were to go around and ask everyone in the class, let's say 10 different people, to let me borrow $10, maybe the first couple people would be more willing to lend me $10 if they knew me or felt nice. But I'm sure by the time I got around to that last or that 10th person, they may be a little more hesitant to lend me that $10 because I have to pay back the 9 people in front of them. So basically, lenders just like to see that you've repaid other people. So it provides them with this sense of security when they lend you money that you're going to pay them back too. So this is that example I was talking about when someone asked me, well, what if I miss a payment? What's that going to do to my credit score? I can't tell you what exactly is going to happen, but this example should give you a good idea. So we have 5 different individuals here: Rachel, Sophia, Mike, David, and Maria. They all have different credit scores that you can see highlighted there at the bottom, and they all have different credit makeups. So different levels of credit utilization. We can see here that Sophia and Mike is pretty high, 50% or higher. Revolving balances. Everyone has different balances. It looks like Sophia and David have lower balances. Credit history. Looks like Sophia and David are also newer to using credit, under 10 years of history. Some of these people have inquiries. Looks like Mike and Maria both have inquiries. And we can see that just Sophia has a couple delinquencies or late payments on her account. So you can see by everyone's credit makeup how their FICO score is reflected. And then on this next slide, we're going to look at a series of credit actions like missing a payment, taking out a new loan, maxing out credit cards to see how will their score be impacted. Here we go. You can see everyone's name at the top there, same credit scores. So first one, missing a payment by 30 days. We can see everyone's score went down there. But then when we go to the next credit action, missing a payment by 90 days, you can see that that played a heavier role in negatively impacting their credit score. So that is why if you do miss a payment, it's okay, things happen, but try and get that paid off as soon as you can. Reducing revolving account balances by 25%. So that means paying off 25% of their credit card debt. Everyone's score goes up here. Taking out a new personal loan, you can see everyone's score drops about 3 to 10 points. And then maxing out credit cards, you can see everyone's score goes down quite a bit here, especially Maria. She dropped almost 100 points basically. So yeah, as you can see, these series of credit actions, they will impact everyone differently. But in this example specifically, missing a payment by 90 days and maxing out the credit cards were the most detrimental to everyone's credit score. So when it comes to building or rebuilding credit affordably, a few strategies: for the highest credit score possible, keep those revolving loan balances like credit cards up to 10% of your credit limit at all times. So that means if you have a $1,000 credit card, you're only putting $100 on that card each month. Set alerts to stay on track or pay down your balance multiple times a month. So maybe you end up going over that 10% mark. You can pay down your credit card balance several times throughout the month so you don't have a hefty balance sitting when your statement comes at the end of the month. Pay any credit card balances in full. So that means completely pay it off. So it's a zero balance moving forward the next month to avoid paying any interest, which is a finance charge. There used to be this rumor going around that you had to carry a balance on your credit card to increase your score, and that's simply not true. You can pay off your credit card every month and still be increasing your credit score. A few tools that we're going to discuss on the next few slides are secured credit cards, credit builder loans, and then unsecured credit cards that have no annual fees or very, very low fees. So first, we're going to touch on the credit builder loan. This is kind of a unique product. So if you do have any questions, feel free to submit them through the chat box, and I'm happy, to elaborate a little bit further. The credit builder loan is a great product because it builds savings and credit simultaneously. You will establish payment history to rebuild your credit or build your credit. So it's set up like an installment loan. So you make monthly payments of the same dollar amount over the course of 24 months. A couple perks: no money up front is required and there's no credit qualification. So that means if you don't have any credit, or maybe if you have poor credit, this could be a really good option for you. We have loan amounts for $500 or $1,000, and you get to choose what you want that loan amount to be. $500 will give you a more affordable monthly payment, but that $1,000, you get a larger dollar amount at the end of the 24 months. So, a little chart on how this works. A member would come in and apply for the credit builder loan with no credit pull. And instead of us handing that member, we're going to do the $500 example. Instead of us handing that member $500, we put that $500 in a certificate of deposit, so it's earning interest over these 24 months. Then, over the 24 months, the member will pay back the loan in monthly installments. For the $500 loan, it's about $23, $24 a month. For the $1,000 loan, I think it's about $47, $48 a month. At the end of the loan, the member will get that $500 or $1,000 plus any interest it earns sitting in that certificate of deposit. So basically, you make your on-time payments for 24 months, and at the end of the 24 months, that's when we give you the money. So you just built up your credit over the course of 2 years, but then you also built up to that $500 or $1,000 that we're now giving you to put in your savings, in your checking, put towards your financial goals, you name it. Next, we have the starter Visa credit card. This is for someone with no previous credit history. So oftentimes I say like a high school student or someone going into college, this would be a good option if they've never used credit before, but do have verifiable income. That is one thing to note, is we do need verifiable income to qualify for the starter Visa. The starter credit card limits are preset by the financial institution. At Zing, we set ours at $300. Basically, we just don't want someone to get over their head in credit card debt. There's no security deposit or money down, and we do provide financial education to answer questions and to ensure they're going to use the credit card in a way that's building their credit, not hurting their credit. Secured credit cards. These are super awesome, but there is one barrier, and you do have to provide your own funds in a savings account to secure the card. So basically, let's say you want a $1,000 credit card. You have to put $1,000 in a frozen savings account that you can't access. And that is oftentimes the biggest barrier to secured cards. It doesn't have to be as high as $1,000 though. There is a minimum balance of $250. So you could just start with $250 and work your way up from there. Interest rates will vary per credit card, per financial institution. Watch out for any fees. And at some credit unions, there's no credit pull required because it's secured, because you're putting down that security deposit in that frozen savings account. One benefit of secured cards I do want to touch on is you can transition these to unsecured cards once you've had about 1 to 2 years of responsible use. And what that means is basically you'd open the secured card, use that for 1 to 2 years responsibly, and then after the 1 to 2 years, you could apply to open an unsecured card. And what we would do is transition this card from secured to unsecured. And all we would do is just give you that security deposit back, put it in your savings or your checking, and now you don't have that security deposit down anymore. So it's not like that's money that we're keeping or we're taking as the credit union. It's just a security deposit in case you were to run up a bill and then not pay it. Some strategies for great credit. Check your credit report at least annually for free at annualcreditreport.com. You can get all 3 of your credit reports there. Pay bills on time and pay off collection accounts. That alone is 65% of your FICO credit score. Keep amounts owed on revolving lines low, like 10% or less of your credit limit for the highest credit score possible, or up to 30% of your credit limit to maintain good credit. Keep your credit history as long as possible, so you don't want to be opening and closing a lot of trade lines or credit cards. Keep inquiries to the necessary, only apply for credit when you really need it. And then lastly, having a mix of credit is ideal, both revolving and installment loans. But as I said, please do not go into unnecessary debt to build credit. So I do have a couple frequently asked questions I'll run through, and then I will open it up for any other questions that we might have today. So first, does my debit or card or checking account impact my credit score? No, it does not. Some financial institutions will do a credit check to open the account, but your debit card or income does not impact your credit. The range of credit scores are from 300 as the lowest to 850 as the highest. This is a really, really popular question. What is a good score for getting a new loan or a credit card? Scores of 700 and up are typically receiving the best rates from lenders. Those are considered good credit scores. The higher your score is, the better off you are. How can I build my score? There are a lot of tools. We actually just went through all of these. So credit cards, secured cards, credit builder loans. Where can you see or find your credit score? This is another really popular question. Experian.com, as I mentioned, once a month you'll get your free FICO score. CreditKarma.com also provides free credit scores. And then if you are a member of Zing Credit Union, in the mobile app, we do have credit monitoring there as well. Can I add my child to my credit card to start building their credit? The answer is yes, but they must be 18 years old. You have to be 18 to have access to credit. Why are my credit scores different when I look on different sites? Which one is real? They're all different. There are different credit scoring systems. So we talked about FICO today, which is really popular, used by 90% of lenders, but there's also Vantage scores. And Vantage scores just mean that that pie chart we talked about today looks a little bit different from them. So therefore the score might be a little bit different from a FICO score. Also, not all lines of credit are reported to all 3 credit bureaus. For example, some places only report to 1 or 2. Oh, someone said Credit Karma is a racket. I would agree. The amount of ads you get as you're trying to just look at your credit score is so crazy. I can't believe how much advertisements they have on there, but that's the reason they're able to provide it to us for free. So that does make me giggle because I would agree that sometimes it's even hard to find your credit score because there's so many ads on there. Where can I access my credit report for free? Annualcreditreport.com, or as I mentioned, Experian.com if you're only looking for your Experian credit report. So those are all of my frequently asked questions. I'm open for any questions now. I am going to go ahead and stop the recording.